Hello and welcome back to my note. So, house prices are booming across the UK. They've even got to the extent where they're able to convert Battersea Power Station in London into new apartments. Is this a new bubble, and is the government really right to be helping people to buy new homes? With me now to discuss this is our property correspondent, Ed Hammond. Ed, thanks for joining me today. Let's start with Exhibit A for those who think this might be a bubble. You can see that when you have a housing bubble, generally it collapses for quite a long time. But in the case of the UK, somehow or other, it didn't get all the way back down before it started growing again. What's going on?
I think the important thing to note here that sort of separates the yellow line from the other lines going down is the UK is fundamentally constrained on the supply side. So where in Ireland in particular, in Spain you can also see it, and to a slightly lesser extent in the US, you had huge development boom going in on the way into the crisis, which meant you had this overhang, this sort of inventory of unused and unsold supply. In the UK, we never really built too many homes. So actually, there was never this overhang. So prices didn't dip nearly as severely and have now sort of just flatlined.
Right. There are no old Battersea Power Stations already in the works.
No.
So what this tends to show, if we take a look at the next chart, is that depending on exactly where you are, there's been a very differential reaction. So the most desirable parts of London have seen huge increases, whereas some of the poorer boroughs have are not recovering at all.
Yeah.
What's going on there?
Well, what we're seeing here is really a sort of microcosm of what's going on in the whole of the UK market, which is this enormous polarisation, really between London and everywhere else, or sort of various pockets of the southeast, but most of the country is down. And in London itself, you're kind of having a tale of two cities. So you have the central, predominantly central boroughs and some of the West London boroughs where prices have just risen astronomically during the past few years, mostly driven by foreign demand. And then the boroughs which are typically UK owners, a lot of them more working class areas and more tied to the domestic economy, you've seen prices decline and actually are only just starting to come back now.
Now let's take a look at another way of viewing that polarisation. This, as I understand it, is transaction volumes since 2006. So the only kind of house brackets where there are actually more business going on now than there was back in 2006 is those that are over £1 million.
Yes, that's absolutely right. And this speaks again to this point about the foreign buyers. So the top end of the market is very much driven by overseas wealth, a lot of it flight money coming in from Europe, a lot of it sort of new investment from Asia and the Middle East. And they will tend to go to Kensington and Chelsea and to Westminster, where the average house prices are sort of around about £1 million. And then also you can see in this one tier lower, again, this is going to be those expensive boroughs that we saw on the previous chart. These would be the poorer boroughs in London, but much more importantly, this line here and these two at the bottom would represent the sort of average UK home.
And we're still in what looks almost like a housing slump.
Very much so.
Now this comes to the critical issue. Your argument, as I understand it, is that while there may be some signs of a bubble in certain parts of London in particular, it's not funded with debt. It's funded with cash, with equity. Take me through what you think is happening.
I think that's absolutely right. I mean, this to me is the most interesting chart. So what this is showing us is that the number of, or the sort of quantum of equity in house price, in house purchases has risen very, very sharply since the beginning of the crisis. And this represents total cash purchases, so people where they've only paid with cash, but then also the percentage of cash in a mortgage, so the deposit essentially. And what's happened is it has risen very sharply as the people who are buying houses tend to be cash rich. They tend to be parents buying properties for their children and unlocking equity from their existing homes, rather than people gearing up and taking on a lot of debt. The point then is that if there is a collapse in house prices, it would hurt a lot of people with equity wealth, but it would not pose the sort of systemic risks that you would have of a debt bubble.
So basically just hurt the people who are rich, even though it's got very ugly social consequences at the moment. That's all that
exactly. And I don't think you would see the sort of the banking collapse and the crisis of credit that you would see in other debt bubbles.
Okay, thank you very much indeed. So I think what we can say reasonably clearly is that this bubble is at least not as dangerous as the last one. Those that will be most hurt would be those who are already very rich in cash. It still leaves an open question, however, as to whether it's really necessary to be stimulating this market just now.